Dear investors, welcome to Phillip Securities Research Weekly Market Update. For 2011, the STI ended 17% down, the MSCI Asia Pacific ex Japan ended 18% down, Euro Stoxx 50 ended 17.5% down, and the S&P 500 ended flat, 0.02% down. 2012 opened with manufacturing PMI figures coming in for Europe and much of Asia. On the data, Euro Stoxx 50, which traded on Monday, gained 2.3%, as although Eurozone manufacturing continued contracting into its fifth month, the rate of contraction eased marginally. And coupled with China's official manufacturing PMI flipping around to expansion, was an improvement in data from the previous month that markets might take well in the short term. For Japan and Taiwan, there has also been a marginal improvement in manufacturing. Nonetheless, we are not out of the woods yet, as new export orders are still somewhat in synchronized contraction in both Europe and Asia. Collective European austerity has had an effect on global growth, with Asia seeing weak demand as well. The only major industrialized nation which seems to be posting positive data is the US, and even then we have reservations about that going forward, as 2012 will be fiscally a lot tighter for the US. That said, employment data this Friday is expected to be market positive. Other market positive news is that unlimited liquidity provision by the ECB has resulted in a backdoor QE. European banks have cycled some of that money into peripheral debt, steepening yield curves. But we warn that the year ahead for the Eurozone is not all clear, as underlying causes, which is economic divergence under a single monetary policy, has yet to be tackled in a big way. Measures of systemic risk still remain elevated. Deficit targets and debt to GDP targets are also likely to be missed, and markets will have to digest these. Overall, the ex-USA industrialized world's synchronized slowdown is a bit concerning, as the Eurozone seems to be in recession, while China, Japan, South Korea, Taiwan and Singapore post weak output data. Singapore itself is likely to see fourth quarter 11 quarter-on-quarter contraction and is likely to post weak growth of below 3% for 2012. Nonetheless, in the short term, conditions seem more positive for global equities on three counts. Better US data, the rate of contractions in Europe and Asia have eased somewhat, and unlimited liquidity by the ECB has resulted in backdoor QE. Despite these, we suspect that the STI will continue to underperform given Singapore's GDP slowdown. On the larger trend for the STI and S&P 500, we remain bears unless, number one, the Eurozone process for fiscal integration actually addresses its suboptimal growth path, and number two, lead economic indicators globally flip around. Thank you, and tune in next Monday to Phillip Securities Research Weekly Market Update.